What is up, everybody, and welcome back to the 22nd episode of the Fresh Finance Podcast. My name is Thomas Elms. I've got my co-host here, Kyle Ryan, and today we've got a special episode. We're having our first guest here, Mike Harvey. Thank you so much for joining us. Mike is a mortgage officer at Vantage Point Mortgage in the Blue Bell, Pennsylvania area, and today's topic is going to be covering mortgages, covering the conversation of what the process and things to consider are for buying your first home or buying that first rental property. And Kyle, I'd love to just kind of intro this with your overall thoughts on the conversation, why this is important from a financial planning perspective. And then we can definitely dive into the content. And just quick disclaimer before I push it over to Kyle, we're having Mike on specifically for educational purposes. This is not technically an endorsement for his services by any means, but more utilizing him as a resource and professional expertise on the mortgage arena, and some things to look out for, some things to possibly try to do in advance. So with that being said, Kyle, would love to just kind of get your first take on the conversation.
Yeah, of course. Thank you, Thomas. And Mike, thank you for being here. Very excited to have our first guest on the show, and also very excited to talk about a topic that I'm keenly interested in. We're in our mid-20s here. It's something I've been thinking about for a couple of years, is buying a house. What does the process look like? Getting a mortgage, figuring out what knowing what you don't know. And that's ultimately why we have Mike here, right? Because there's a lot of different opportunities, strategies, programs in place in the world of getting mortgages that can seriously save you some money, right? So I'm very excited to hear what Mike has to say for us today. And yeah.
Perfect. And Mike, to kind of intro you here. So again, Mike Harvey, Vantage Point Mortgage. You guys are in the Pennsylvania area. Would love to just kind of get a little intro on you, how you got into mortgages, how you got to Vantage Point. And then if you could just kind of intro us on process, what type of clients that you're working with and what it really looks like to get it pre-approved, apply for that mortgage, and then, hopefully kind of buy that first primary house, that first rental property, kind of what that process looks like.
Yep, of course. And thanks for having me today, guys. Happy to, have a conversation and, hopefully individuals can get some good information out of this. As far as from my side goes, my story, I got licensed to be a loan originator, a mortgage broker when I was finishing up college. So I went to school in North Carolina, moved back home. Awesome. And linked up with actually my cousin at the time who was opening the brokerage. And then we've been together. That was in 2013. So since then, and from our side, we specialize in helping individuals purchase properties, whether that's a primary home, investment property, or vacation home in a few different states: Pennsylvania, New Jersey, Delaware, Florida, and New Jersey. So most of our clients are individuals who are looking for that new primary home, or vacation home, investment property, and pretty much everything that we do is all referral based. So we work with financial advisors, real estate agents, CPAs, helping their clients hit their goals depending upon what they're looking to do with real estate. Got it.
And walk us through the process here. So I'd say let's just use Kyle kind of as our figurehead example here. Is, if Kyle's looking to get that first primary residence, can you kind of walk us through the steps as far as what he needs to do, take care of, what professionals he needs to reach out to, what documents he needs to get done, kind of what does the process look like from I don't own a home and I'm just kind of looking to we're closing on the property and, we're about to buy this home?
Yep. And overall, I think the internet has, helped us in some ways, but it's hurt all of our industries possibly, right? In the sense Absolutely. Of people believe that there's so much information out there that they can do things on their own. And, it couldn't be further from the truth, because it is very important to have a good team around you with whatever you're doing. So from the home purchase side, right, it's very important for somebody to have a good team around them as far as the financing goes, from the real estate agent. So what we like to do is get in touch with somebody, right? Get the process going to evaluate what they can or can't do. A lot of people have no idea what their buying power is. They have no idea what it costs to purchase a home. They really have no idea about the process and what it takes. So the first thing that we always recommend to somebody is, after having that initial conversation, if it sounds like buying a home makes sense for them, We always start with the loan application, right? The application is the first step that gives us all the information that we would need to pull a copy of their credit, because credit is always potentially the first killer, right? If you do not have a proper credit score, or if there are items on your credit report that would disqualify you from getting approved, that's a hard stop, right? So then we can, if let's assume somebody doesn't get approved with the credit, we would help them with that. We're not a credit counseling agency, but we can say, hey, you should take care of A, B, C, D, just in general terms for things that we see would help somebody. But after that, we would, evaluate their income and assets, right? So the big items that somebody has to be mindful of when getting approved are your credit, the income that we're able to use for the qualifying purposes, and then the funds that you're going to be using for the purchase as well.
Yeah.
So those are the main items that we review with someone up front to determine what they can get approved for, what types of loans might be available to them.
Okay. Got it. Got it. And what would be, you're kind of talking about qualifying, disqualifying events. I think that's a really important concept here. What would you say are kind of like some things not to do while you're kind of going through this process? Is there anything that really kind of sticks out for you from your experience where, everything was either going smoothly and then, there was this disqualifying event that, somebody did or something of that nature? What are some things kind of not to do while you're kind of in the middle of this, loan application process?
So when we're evaluating the different, qualifying parameters for someone, right? The first would be credit, right? So as credit reports are good for 120 days from when we pull it to when the person would settle. So basically, if you're making your payments, continue making your payments. If you take out any new debt, we would have to get documentation for that, whether it's a credit card or a car payment or anything like that. We'd have to get documentation for that to see what that new monthly payment or liability does to your qualifying. Sometimes it doesn't change things. Sometimes it might, right? If somebody has a car payment for $300, they go get a new car for $700. That additional $400 a month in liability could change what they can get qualified for. So we tell people not to apply for new items through the search, but sometimes somebody has to, right? They have a lease that's coming due and they have to get a new car. So we can pivot with things like that. But from the credit side, it's try not to take out any new debt just because we'd have to hold that new payment against you. Income wise, obviously, if somebody was to change jobs, right? Changing jobs in the middle of a process is not a deal killer, but we would have to document the new position, the new income, whatever that compensation package might be, and if there is going to be any delay between ending one job and starting another. But anytime somebody changes a job, we would have to get new information for what that scenario is, but it's not necessarily a deal killer. If somebody goes from W-2 position to a 1099 position, that would be a problem, right? Banks do like to see a history of a 1099 or self-employment type income for longer than just a short period of time. So something like that could be an issue. And then as far as the funds go, right? If we verify that you have X amount of dollars today, but you spend that money, right? Obviously, if you need all that money to close, you're not going to be able to come up with that money to close, right? There are ways somebody could get a gift or pull money from a 401k or some type of retirement account. But in general, if you spend money you're supposed to be using for a purchase, it could disqualify you. If you lose your job or get a new job, obviously we'd have to figure that out. And then credit items.
Yeah. And I think, sorry to cut you off. I just, there's so much to unpack here. And I just want to make sure that people are getting the highlighted important points here is, we want to make sure that income is stable and we're not making any changes to jobs. And I think that's where the planning aspect and having a team really does come into play is when you're buying this primary residence, vacation property, rental property, whatever it may be, you want to make sure that everything in your life throughout that period is not changing other than this, right? Is, making sure you're not taking on any new debt, not setting up any new credit cards. You're not changing jobs. And then I'd say the other thing too, that I have experienced in my relationship with the people that I serve is get ready for having statements available. Any sort of, if you're pulling monies for a down payment, from an investment account or from a bank account, making sure that you have access to statements quickly. I don't know if you would agree with that or not, but also making sure you've got all of your income documentation, any sort of tax returns, pay stubs, things of that nature. But having those documents readily available is also super important as far as being timely in the process too.
For sure, because we deal with a lot of individuals where we might need 2 years of tax returns or 2 years of 1099s or W-2s, K-1s. Most individuals are not as organized as they should be with those basic documents, right?
Yeah.
You
And
file your taxes for 2021, and most people just get rid of those items, right? They don't really save them in an organized place. So having those items, organized is very important. Same with bank statements, right? Some lending or some banking institutions make it a little bit hard for some people to find their statements online, right? We have to walk people through the process of where to find their statements very often. So it is important to have those items together. You can always go to the bank and get a statement printed out, something like that, but it obviously adds a little bit more to the process for someone. But that's why it's important to work with somebody that you trust, right? You trust that we're telling you that we need things that we actually need, right? We're not going to send you on a goose chase for documents that we might not need, but it is important to have those items readily available if you can.
yeah. And I think that is kind of like a funny piece because I actually have had some people, have kind of like sidebar conversation with me. It's like, why does my mortgage broker need this or need that? And the reality is, why would they ask for it if they didn't need it?
Yeah, they don't need your
You know,
papers floating around.
yeah, yeah,
But
no,
I
yeah,
think it's really it's important for people to remember that purchasing a home, the first one, second one, or whatever it is, it's one of the largest purchases you'll make in your entire life.
yeah,
So there's, of course, especially when you get a mortgage, there's going to be a lot of due diligence to make sure that you can afford to pay that. Because
yeah,
if you can't, it's not just you who's on the hook. It's
yeah.
people who wrote you your loan.
Yeah, yeah, absolutely. And would you real quick, would you kind of talk about the difference and maybe documentation that's needed between maybe a W-2 employee, somebody who's been a W-2 employee for a while versus maybe like a 1099 employee? Because I've heard that there are some differences there as far as, what documentation is needed. Is that something that you could maybe talk about real quick?
Yeah, of course. So somebody that's a W-2 employee, they get a paycheck every month. Lenders will use that number. So if somebody makes $120,000 a year on a W-2, they receive $10,000 a month. The bank is going to qualify them on $10,000 a month income.
Yeah.
Somebody that's a 1099 employee, they'll file their taxes, they'll have certain write-offs, they will deduct certain items from their income as well. So we'll also need those tax returns to be filled out. And in that, right, if somebody has a $120,000 1099, they will most likely have deductions and expenses out of that would lower the amount that we can use to qualify them for a loan.
Yeah.
And
So
how
there
far
is
back
always
do
a
you
little bit of a balance between, from a self-employed person in many cases, hey, I don't want to pay as much in taxes, but I want to get approved for a loan, right? We deal with individuals kind of having that internal conversation a lot, and we can only use what's on those tax returns.
Yeah. Yeah.
Yeah.
That's super important. And then, could you kind of dive into loan options, as we segue more into the conversation, kind of what types of loan options are available between, varying credit levels, varying, property options, whether it's primary or vacation or, an investment property. Can you kind of just like talk through what that, type of situation looks like?
Of course, and overall, most of the loans that we do are loans that are going to be Fannie Mae or Freddie Mac type loans, right? So, and we mentioned documentation, right? All of these loans that banks are writing at favorable terms, what you see online and what you hear about as far as interest rates go and low rates, those are all loans that are going to be backed by Fannie Mae or Freddie Mac, right? And part of needing those documents is to make sure that the lending institution who is giving you that loan can then sell that loan off should they need to, right? So that you can hit those guidelines. Now, most of the loans that we do are going to be either conventional loans, which are, those Fannie Freddie loans, FHA, we do USDA loans, VA loans. So there are different types of loans available. FHA to some people is known as like a first-time home buyer type loan. Part of that is because you can do as little as 3.5% down, and they are more forgiving as far as credit scores go, right? Conventional loans, they do prefer higher credit scores.
Yeah.
But you can also have conventional loans with as little as 3% down for a primary home.
Got it.
So a lot of it depends on the individual's profile. what their credit score is, the amount of money that they have for down payment, where that down payment might be coming from, whether it's coming from a relative or one of their accounts, whatever the case is. And then you can look at just some of the items that show up on their credit, right? Some items on credit, whether it's collections or judgments, may disqualify someone from one of the two loans, right? Without getting into too much detail, but there are, loan options for individuals as long as you can meet those basic guidelines.
Got it.
And Mike, what sort of variability would you see for someone with a very poor credit score applying for the same mortgage as someone with a great credit score in the 800, say? Is the difference purely more often than not in the interest rate, and how high can that interest rate differential be?
So it can be a pretty big swing. For FHA loans, we're going to see a less differentiating, rate for somebody that has a good score compared to a lower score. They don't penalize as much if somebody doesn't have a great score, and their mortgage insurance, which is the monthly mortgage insurance that someone would pay, would be fixed. So whether you have an 800 credit score or you have a 600 credit score, you will pay the exact same monthly mortgage insurance premium with an FHA loan. With conventional loans, that can drastically change, right?
Yeah.
Somebody that has a good credit score could pay, an eighth as much as somebody that has a poor credit score if they had to go that route.
Yeah.
Right. So we can see wild swings.
When you say an eighth as much, are you talking on the monthly mortgage payment, or are you talking on the monthly mortgage insurance?
The monthly mortgage insurance.
Got it.
Right. So like monthly mortgage insurance, those premiums are based upon a rate. So if somebody has a very good credit score and they're putting, that's like even 5% down, right? That mortgage insurance rate might be somewhere less than like 0.25%, right? But if they have a poor credit score and still putting 5% down, it could be well over 1% of that, of the rate that they pay. So that would lead to a higher monthly payment for some of those individuals.
Got it.
You can imagine, it seems like there's a lot to navigate here based on your own individual circumstances. So let me paint two different pictures for you, right? I'm 25 years old. I've got a decent amount saved and my credit score is terrible. I don't want to put a lot of money down because I want to keep money in the bank. I'm not concerned about interest rates or primary mortgage insurance or anything like that. I would think I'd be a prime candidate in that instance for an FHA loan. I have a very low down payment. I can get qualified even on a low credit score. Does that seem reasonable? Do you see a lot of people with lower credit scores want the less down payment? It seems like they're funneling toward the FHA loan.
A lot would prefer it. Right now, FHA, they do have an upfront mortgage insurance fee as well. So they charge 1.75% of your loan amount, and they just add it on top of your loan. So if you had a base loan amount of 200,000, right, they would add that 1.75% to your starting loan amount, and it would be a little bit higher. So you do have some factors like that to just consider. But overall, FHA is a great program. Right. Some sellers are a little bit more hesitant to accept an FHA loan. So something like that can come into play as well. Like if you're offering with an FHA offer and somebody else is competing with a conventional offer, some sellers will look at that conventional offer to be more attractive. They are a little bit more lenient on some of the items for an appraisal that's conducted, but it's just something that we see. So obviously you have to keep that in mind as well. Sometimes we have agents that say, is there any way this person can get a conventional loan because they're not going to get an offer accepted FHA? So items like that are also considered, as far as being competitive, because the loan that you can get is only as good if you can get the house, right? If we're offering you a loan program that kind of disqualifies you from even getting an offer accepted, there's not much point in that, right? Unless it's the only loan program that you can possibly get qualified for.
That is such an important point there.
I love that. Yeah. So it sounds like the answer depends.
Correct, right? And
like
every situation is different, right? If somebody comes to us and they can only get approved for an FHA loan, and there's a house that's been sitting out on the market for a couple months and the sellers can't really sell it, and it's not in the most attractive area, whatever the case is, right? FHA is in play for those people, right? But if it's the brand new house that's just been renovated on the block and there's a lot of people that are lining up to see it, you're probably not in play for a conventional loan, right? During the COVID, when rates were lower, even we saw a lot of offers getting accepted just cash, right? People are just going in, putting in offers of cash, and even somebody with 40% down payment for a conventional loan, they weren't even competitive, right? So a lot of it just depends on the market, the specific property. There's trade-offs, right? So if you want to buy a home, but you can only get qualified for certain types of loans at this time, unless you're going to improve your scenario and get it, save more money, get approved for different types of loans, you might just have to only look at certain types of homes as well.
I think that's such a good point. And like looking at how and what type of a mortgage you're going to get, what type of a loan you're going to get in the lens of how can I be competitive to actually win this property. I've never looked at it that way. And I think that that's such an important thing to take into consideration, because I think especially with people who are buying a home for the first time, they have this delusion of grandeur where they think that they can just apply for this mortgage and then go check out this house on the block and then make an offer, and then they'll just get the house and close in 30 days with no issues.
Yep.
And I think that there was a huge wake up call kind of in that 2020, 2021, even like early 2022 timeframe, where we saw these people were coming in with cash offers, a lot of, at least in the Kansas City area, cash offers over asking.
Yep.
And you're not competitive if you're in a situation where you're trying to go against those offers with an FHA loan. And just kind of evaluating the competitiveness of what you're bringing to the table for that seller. But also balancing that idea with how much can I afford and what's the best type of setup for me in particular for my specific financial situation. And I think that just gives credence to the idea of how important it is to be financially stable and sound, and have cash assets when you're going in to buying a property and having a good credit score.
Yep. And appraisals are a big part of the entire process of buying a home, right? So all lenders are going to require that, they have an appraisal that says what we're lending you on is worth that amount, right? So as the values ran up very quickly, we saw, the possibility of people being worried that a house wouldn't appraise for the sale price, right? And if somebody's putting 20-30% down with a conventional loan, they have a little bit of a buffer that if the appraisal comes in slightly under the amount of the sale price, either the buyer is able to make up that difference but still pay the same amount for the home, or they can just, maybe it would eat into their equity a little bit for that purchase. Somebody putting 3.5% down on an FHA, it can't appraise light because chances are they don't have any other money to make up that difference. And then the seller is going back to the market to try and resell the home as well. So, things like that, whether it was just the sudden appreciation, the flood of individuals and buyers coming into the market, whether it was cash or any type of loan that we saw really, lead to the run up of home prices, but being competitive matters.
Yeah, absolutely. So let's do this. Let's say that we've gone through the loan application, the pre-approval process, and we've gotten accepted. Okay. And let's just leave it super general. We have a specific value that we are eligible for to get a mortgage or to purchase a home. So now we start actually looking at properties in that loan value. So let's say that we've gotten to a point where we have sent out an offer and that offer has been accepted. Okay. And we're initiating kind of the beginning of that closing process. Can you kind of talk through with us kind of from a loan perspective, what types of things are happening at this point?
Yep. So once we approve somebody for a mortgage, one of the first things that we like to do is have them send us properties that we can send them numbers for, because it's important for them to know what's an approximate cash out of pocket going to be and what is an approximate monthly payment going to look like with certain price points, right? Yeah. Because we don't want them to get a house under contract and the first time they see the amount of money that they owe and the monthly payment is when they're under agreement, right? So we do need to kind of set a baseline because it helps them determine their appetite for certain types of homes and certain ranges. So we do want to set proper expectations for someone up front so they're not looking at $500,000 homes if they don't like a $500,000 monthly payment, right?
Yeah.
But once somebody is under contract, what we'll do is we will, from our side, we'll shop around and make sure that we can get them a great deal, right? Make sure that we work with many different lenders that have different types of loans that they like. Some prefer FHA loans, some prefer a conventional or different down payment amounts. And the monthly mortgage insurance rates are not all the same with all lenders. So we would see, who's going to offer them the best terms, while also keeping in mind what's really important. And a lot of people kind of discredit this, the guidelines or potential overlays that certain lenders have. Not all banks have the exact same guidelines. They don't all have the same process. So it's important to know that if we're going to give somebody a loan, they're going to be 100% able to get approved for that loan.
Got it.
So back to the approval process, a lot of times we're asking them for additional items to back up or know what the underwriter is going to ask for ahead of time, so that we know they're not going to have any issues. But once someone's under contract, we'll get them locked into a loan. Lots of documents and disclosures and things for clients to sign. But after that point, they'll have their inspections, if they're allowed to have inspections on the property. We're seeing more inspections come back on the market. Obviously, rates are higher, payments are higher, but it's a little bit healthier as far as someone being confident that they're buying a home that they can have inspections on, so that they're not going to purchase a money pit, right? So we'll get them locked in. They'll have their inspections. Right around that time, we'll also order the appraisal to be done. An appraiser will go out, make sure that the property is worth what the person's purchasing it for. All while this is happening, we're underwriting the loan fully on the back end. There's a lot of things that we can't do until they have a specific property in mind. They have to get homeowners insurance, and the title search is conducted. So while that's all going on, as far as the appraisal side goes, we're basically finalizing the underwriting of the loan. And then, we'll request some documents, updated bank statements or pay stubs, things like that. And then we'll get someone ready for closing. That normal process, I would say right now, is probably between like 30 and 60 days.
Got it.
Right. We can process loans faster, but most settlements in general are between 30 and 60 days, just because sellers like to get organized. It's just a nice, healthy timeline. Probably takes about a couple weeks to get the actual title report back anyway. So you can't move much faster than that, to be honest.
Mike, I've got two questions for you on that. Thank you for outlaying that entire process. That was really well done. When you mentioned going to the various lenders for different programs, I think, and correct me if I'm wrong, I think that's the huge value of using someone like yourself as a mortgage broker, because if you go directly to the lender and you're looking for a specific program, say an FHA, and they don't want to add any more loans to their book, they might offer you an FHA at terrible rates and you wouldn't know the wiser. And that's why having a broker like yourself who's able to go out there and surf through the market to find the best deal for their clients so valuable.
Yeah, right? For sure. Right. And some lenders prefer FHA, some prefer conventional, some prefer lower down payment or more down payment, or condominiums to single family homes, whatever the case is. So not all lenders have the same appetites for certain loans. So
they could change daily, right?
Correct. Right. And, I think some lenders on a certain day or maybe a month, they want to get a number of loans in their pipeline. They'll improve their rates, right? They'll offer some deals, or if they get a little bit busy, to keep up with turn times, right? Because then on the back end, these underwriters and closers, they do only have so much bandwidth, right? And if they're a little bit busy, certain lenders might increase their rates to slow down the amount of loans that are being sent to them as well.
That makes perfect sense. Supply and demand, right?
Yeah, right. Maybe to get busy, or they'll lower their rates to attract more deals in. So it's something that we see often. Not every day the same lender is the best priced. And even if somebody is the best price, it doesn't mean that we're going to send a loan to them if we know that they, look down upon something about someone's specific file, right? Fannie Mae and Freddie Mac have their guidelines, but that doesn't mean that all lenders aren't allowed to have additional guidelines on top of those as well.
So, yeah, definitely. I just wanted to bring that up so that people don't, think, oh, I've been using this bank for 30 years. I'm just going to go through them and they'll serve me well. One other thing I wanted you to comment on, something you ended with, was closing costs. I've often found that closing costs can really surprise people, and not in a good way. You think I'm going to get a $300,000 mortgage, I don't know, 20% down payment. I'm going to come to the table with $60,000. Not the case sometimes, right? You have closing costs. Can you talk about what sort of closing costs people might see? I know the price of it will fluctuate greatly depending on where you live and among other things, but can you talk about what sort of closing costs people might be able to expect and the difference between refundable and non-refundable closing costs?
Yep. So overall, for closing costs, right? This is taking someone's down payment out of the equation, right? You'll have your down payment, but when you're obtaining a mortgage, all banks are going to require somebody to get title insurance. Title insurance, where we are in Pennsylvania and some of the other states, is set by the federal level. Those amounts can vary, but they're usually set by the amount of the purchase price. So if somebody's buying a $500,000 home, whether they are getting a $100,000 loan or $400,000 loan, that total policy is going to be the same amount, right? Each bank has their own, whether it's underwriting, processing fees, origination fees, different things like that you can be, mindful of. Yeah. Obviously, you can pay points to lower your interest rate, or you can take a higher rate, maybe take a lender credit, something like that. Transfer tax, where we are in Pennsylvania, it's usually about 1% transfer tax. Philadelphia County is over 2% transfer tax, and that's per side. So in like Montgomery County, Pennsylvania, it's usually 2% transfer tax total. That's split between 1% the buyers, 1% the sellers. But in different counties and areas, it can vary based on what those costs will be.
And that's not a small 1% number when you're talking about $400,000 or $500,000.
Yep, for sure. So depending upon where you live, that fee could vary, but even on the lower ends, it's usually, now some states have like mansion taxes where those fees only kick in when you get to a certain price point, but just something to be mindful of. Most borrowers will pay 1 year of homeowners insurance and 1 year of property taxes at settlement. That does vary based on where you live and how your taxes are collected. But usually, pretty much all lenders are going to require that you pay 1 year of your insurance premium up front. So it'll cover you from that day for the next 365 days. And then next year you would pay, for the year going forward. And with your property taxes, anytime you're dealing with a bill that's paid going forward, you're going to have to pay that number at settlement, right? So whether you're reimbursing the sellers for property tax they have prepaid for, or putting some money into your escrow account for future payments, it comes out to be about a year. So those are kind of the main items to be mindful of. And where we are in Pennsylvania, those closing costs normally come out to be somewhere between 4 to 6% of the purchase price as well.
And not a small number.
No, it's not, right? And now you can get seller assist to cover some of those fees. But in general, you're looking probably somewhere between 4 to 6%, and that varies based upon what your transfer tax is and how much your property taxes are.
Those costs add up. We always tell people, especially with starter homes, you're going to want, you don't just buy a home and quickly sell it. The price of your home needs to appreciate a good 10% for you to even break even. You add in the transfer tax, like you're talking about, all the closing costs. It's not a quick flip sort of investment for most people, right? So these are substantial costs.
Yeah, they are. And obviously you have the appreciation of a home, you have some of the tax benefits, but you're paying 6% to a real estate agent, to two real estate agents for as far as listing and someone buying, plus transfer tax and title insurance on the purchase. Especially in this environment, right? I think what we saw was when rates were really low, everybody wanted to get approved for a mortgage because the payments were very low. And anybody, whether they needed to move or they just wanted to move, were in the market to purchase, which led to the frenzy. At this point, with rates being higher and monthly payments on a purchase not making as much sense for many people, it's much more of a need to move kind of industry, right? If you need to move, if you have kids and you need to get into a school district or you need more space, whatever the case is for those individuals, we're seeing a little bit more of much more of those people being the ones that are primarily buying homes right now. So if you need to move, you're willing to spend those costs, but in general, it's not free to purchase or sell a property.
Yeah, I was reading a stat from the other day where it was like when mortgage rates were in the low twos, a $250,000 mortgage would cost you, I don't know, somewhere $2,000, let's say. And now with interest rates in the 6-7 range, like your payments almost doubled for the same amount of home. It's crazy. It's crazy.
Yeah, the payments really have risen, and we still have a lot of people that started looking in 19. And maybe they're looking to buy $1 million house and just still have not moved, and maybe their need hasn't exactly popped up yet. Maybe they're a little more flexible on their timeline, but in general, it is much more expensive to purchase right now as far as the monthly payment goes.
Yeah.
And coming from kind of the interest rate conversation, obviously we talked about rates have risen dramatically here over the last 12 to 16 months. Um, can you talk a little bit about the refinance process? Because we saw so many refis and kind of that early 2020s time frame, 2020, 2021, even, right at the start of 2022. Can you kind of talk about if somebody were to hypothetically purchase a home maybe this year at a high rate, relative to what we've seen over the last 10 to 20 years. And then let's say that there's a hypothetical situation where rates start to decline again. When maybe we get inflation under control, rates start to go back down, and somebody that purchased a home with a higher rate wants to refinance at a lower rate. Can you kind of talk to us about what that process of refinancing looks like and some of the costs that are associated with refinancing?
Yep. So pretty much any loan that we do is not going to have something like a prepayment penalty, right? Most loans nowadays, they don't have prepayment penalties. They don't have balloon payments. We saw more ARMs come into the market, which like adjustable rate mortgages. We saw more of them come in, but overall, you can refinance a loan at any point in time, right? As long as you can qualify for the loan. And qualifying for a refinance and refinancing is a very similar process to purchasing a home, right? Similar timeline, right? You're most likely going to need an appraisal. You will need title insurance to be run again on the property, just to make sure that there's no additional liens or liabilities that were taken out on the house.
Mike, is that if when that gets run again, is that an additional, say your house is worth 500,000, is that, and it's a 1% cost, just say, are they going to charge you $5,000 again to do that?
So not for the transfer tax. So
Okay.
you wouldn't pay transfer tax because that's just the property changing hands, changing ownership, but you will pay title insurance. So title insurance for refinance, you only pay based upon the loan amount that you're borrowing. And it is prorated a little bit. So a $300,000 loan on a purchase and refinance are not the exact same cost, but it's most of the cost, right? When you refinance, the larger part of your cost is going to be the title insurance and the title related fees. You might, some people will set up new escrow accounts, which could add to, you can roll that in to your loan. So you won't actually be out of pocket for that. But in general, your true costs, as far as like, what does it cost for me to do this? Money that's just going to somebody for a service is going to be for those title insurance fees.
Got it.
But you can refinance at any time, basically. So there's not going to be any type of prepayment or penalty to doing so. You're not going to be stuck with that loan for a certain period of time. But yeah, so if rates were ever to come down, you can always refinance, right? At this point, if somebody's getting a loan at 6%, they could refinance at 5%. If they go to 4%, they could refinance again. There's really no limitation to that for refinancing.
Got it. So that process is very similar to the purchase process as far as timeline. It's just the thing that you want to definitely understand is that there are going to be some costs involved as far as, updating your title insurance, things of that nature. And then just kind of going from there. There's really not a time in which you can't do a refi. It's just ultimately up to how frequently do you want to do it? How much is it actually going to alter or better your situation? And what are the costs involved?
Yep, for sure. Like timeline goes, it's only the borrower themselves, right? So you still have to verify income, and you have to verify, most people don't need assets if they're not bringing any money to the settlement, but credit and income are always going to be verified. And then it's basically as quickly as the consumer can move, right? Obviously, we'll need documents to be signed, and they might need an appraisal, so they have to schedule that. It's on the faster end, but in general, you're going through pretty much the same process as when you purchase the home.
Got it. Kyle, I don't know about you, but I could not imagine trying to do all of this alone.
Oh my God. No, I remember 2020 when that happened. I was like, I'll dip my toes into the housing market, and I got pre-approved. I went to the first open house, saw a line of 13 people outside, said, not for me. Hindsight's 2020. I wish I stuck it out. But yeah, no, I tried going through it on my own, and it was a daunting process. And you need someone there, even like the loan programs available to you, like the difference between, because without thinking, I'd say, oh, I want a less monthly, I want a lower down payment. Let me just do an FHA loan, not realizing how uncompetitive that may be. So that was really intriguing to find out.
Yeah, and even just down to, what documentation I need, what types of things do I have in place, and then even, Mike, what you were talking about. understanding or just not understanding as somebody who's not in the industry that there's certain lenders that want certain loans, or that are experts in certain loans or provide the best rates for certain loans. And even just from a seasonality perspective is, who wants what and who's offering the best rates, but being able to leverage somebody else and delegating that expertise to, somebody like yourself, Mike, and having them go find you the best quotes. And, that's something that we see often, from a life insurance perspective, just go totally different, avenue. But it's like, there's a lot of people that will see a commercial on, on TV and be like, oh, you know what, I do need some life insurance. That looks like a good quote. And then they'll just start throwing money at it. Whereas, somebody could come to, myself or Kyle or an independent advisor, and we've got the ability to shop quotes, find the best rate, but also find the best insurance policy for them. But I think it just gives so much credence to how much work on the back end that these people don't see you actually do. This is kind of like illuminated all of the things that, loan officers actually do for people when they're trying to buy a home, trying to refinance, that are just so invaluable to me.
That's why I loved when I asked the question. I tried making it as plain Jane, like, yes, you want an FHA loan, but no, the answer is always it depends. And it's the same thing in our industry. And you don't want someone who's just going to tell you something thinking you won't research it, or, you have to be honest with people and give them the circumstances that it might not work out.
Yeah. Yeah, absolutely. Mike, do you have anything else that you wanted to talk about? Because I know we kind of had a set process here, but even just throughout our conversation, I've heard you say something and then we brought it up. Is there anything else that you think would be helpful or beneficial, for people to know about as far as going through this loan application through closing process?
Yep. Overall, I think it's very important for somebody to, and we talked about this a little bit, but to work with a team that that you trust, because every individual is very different. Everyone's scenario is different. We deal with a lot of problems on the back end of files that individuals never even know about, or things where they're unable to give us some type of documentation, so we decide to go another route for something. Whatever the case is, you have to know that who you're working with has your back, and if something goes wrong, they're there to support you and make sure that things get worked out, and that you trust them, because there are a lot of options, right? We can go over 100 different options with someone, but I think sometimes it's important to give them some options that they feel like they're getting as many as they can possibly handle and digest. If you give someone too much information, they're not going to be able to decide what's going to be better for them. So it's helping guide someone through the process and keeping them moving along in many cases. People get buyer's remorse, right? Yeah. People go under contract and then they think they're making the worst decision of their lives, and they all end up being happy about it, but it's helping them kind of just navigate the process and make it nice and stress-free. So the team around you is very important.
Yeah,
absolutely.
Absolutely. Well, hey, this has been incredible. I really appreciate your time, Mike. I appreciate your expertise. I think you brought so much value to the conversation of what this process looks like. I really hope that people have paid attention and watched this whole episode, especially if they're in the market for buying a home, getting that first loan, things of that nature, or if maybe they've got a property under their belt and they're looking for a vacation home, and maybe these are things that they didn't consider or didn't run into on that first property. And now that they can, now that they have this information, they can, take that and run with it. But really appreciate your time, Kyle. Thank you for your insight as well. Thank you to everybody that's listening, watching. If you have any questions, feel free and reach out to us on our social media pages. They're linked here on the YouTube channel, or you're seeing it on LinkedIn as well. Mike, again, thank you so much for your time, and we will see everybody next week.
And as always, our contact information will be in the bio. Mike's will be down there as well if you ever want to reach out to him.
Yeah, cool, for sure.
Thanks, guys.
Thanks, Mike.
Thanks for having us, Mike.
See you next week.